So, have you ever wondered what goes on in a professional trader's mind before the market even opens? It's not about hunches or guesswork, right? It's about building a detailed, rock-solid battle plan. Today, we're going to dissect a real-world game plan for the NASDAQ futures, and we're going to break it down piece by piece. You know, every great plan kicks off with a single clear idea. And for this day, the core thesis was simple: bullish continuation. The market was likely to just keep on chugging higher. But this isn't a random feeling. It's a conclusion that's built on a careful analysis of what the market is actually doing. And that, well, that's the million-dollar question, isn't it? I mean, it's one thing to say, yeah, I think the market will go up. But it's a whole different ballgame to know exactly where you're getting in, where you plan to take profits, and, maybe most importantly, where you'll get out if you're wrong. That's what we're going to unpack right now. So here's our roadmap. First, we're going to get a feel for the market's mood, the why behind that bullish idea. Then we'll map out the key levels that matter. From there, we'll build a specific game plan, we'll crunch the numbers on the risk, and finally, we'll cover the rules for actually executing the trade. Okay, so let's start with the big picture. Before a single trade is even on the table, a pro has to understand the underlying context. What's actually driving the market? So what was propping up this bullish idea? Well, we have some pretty strong pillars. There was positive economic data coming out of China. Tech was showing some real resilience, especially a giant like TSMC. And technically, the chart structure was holding strong. Now, yeah, there was some fear of heights at these levels, but all the data suggested the path of least resistance was still higher. All right, so we've got our why. Now we need the where. You got to think of trading as a game of location, location, location. It's like a battlefield, and professionals map out exactly where they expect those major fights between buyers and sellers to go down. And to understand that map, you have to know this term, the CME settlement. All it is the official closing price from the day before. But for the big institutions, for the big money, this price is a critical reference point. It is truly their line in the sand that defines whether the market is starting the day strong or weak. And this is how those levels get organized. It's so clear. You have a resistance level, which is kind of like a ceiling. You got a support level acting as a floor. And right there in the middle, you have the all-important pivot. This is basically the trader's GPS for the day. And here is the crucial point. That pivot is the CME settlement we just talked about. The fact that the market is set to open above this number, well, that's a massive confirmation for the bullish plan. It's the market telling the trader that buyers are in control right from the start. All right, now let's see how this all builds into the most critical part, the specific, actionable game plan. We have the bias, we have the map, now we need the exact coordinates for entry and exit. This is where the theory becomes practice. See, the entry at 26,380 isn't random. It's waiting for a confirmed breakout. Then you've got two different profit targets, which is a smart way to systematically reduce your risk as the trade works. And look at that stop loss. It's placed just below that critical CME settlement. Why? Because if that level breaks, the entire bullish idea is just plain wrong, and the trade gets cut immediately. You know, a plan without numbers is really just a wish. And for a professional, this next step is completely non-negotiable. You have to calculate the precise risk and reward to make sure the trade is mathematically sound. First up, risk is defined in the market's own language, points. The distance from that entry to the stop loss is exactly 25 points. That's the maximum the trader is willing to lose on this one idea. So what does that mean in real money? Well, you translate those points into a hard dollar amount. For this specific plan, trading 2 contracts, the total potential loss is capped at $100. There's no ambiguity, no emotion, just a clear, predefined number. Now, on the flip side, you have the potential reward. If the trade works out and hits that final target, the potential gain is $418. So now we can directly compare what's being risked versus what could be gained. And that right there gives us the final critical metric, the risk-to-reward ratio. Here, it's 1 to 4.18. This means for every single dollar being risked, the plan offers a potential return of over $4. This is what we call positive asymmetry, and it's the secret sauce to long-term profitability. And this quote from the source really says it all. Professional trading firms demand this kind of mathematical edge. They aren't looking for gamblers. They're looking for risk managers who can consistently put the odds in their favor. So we have the plan, we've done the math, but honestly, the hardest part is still ahead. Executing that plan with discipline when the market is moving and emotions are running high. This is where your rules of engagement become key.
And this slide just perfectly contrasts the amateur versus the pro. The amateur gets lured into the trap, trading the chaotic, noisy open. The professional plan? It has a mandatory rule: wait 15 minutes. This lets the initial noise die down and helps avoid getting caught in common traps. It's all about patience and executing on confirmation, not impulse.
And it all comes down to this simple final checklist. At 9:45 a.m., are the conditions still valid? Is the price still holding where it needs to be? If the answer is yes, you execute. If it's no, the plan is put on hold. You see, the trader doesn't chase the market. They wait for the market to come to their predefined conditions. So there you have it, a complete professional trade plan, from the big macro idea all the way down to the final execution click. The analysis is done, the risk is defined, the rules are all set. The only question that remains is the one every single trader faces at the start of every day. What happens when the market actually opens?